In the morning, then text me down. Slide through, damn. And the shit, when you working, bitch? And them beat them so, damn. It is time, my boy. It is time to show y'all the strategy, brother. The strategy, brother. It is time to show y'all how to trade iFVGs, inverse fair value gaps, little nigga. Inverse fair value gaps. That is the strat. That is what's going to make you money. Inverse fair value gaps. I hope by this point you have a good understanding. Fuck is I'm doing, nigga. I hope you have a good understanding of what a fair value gap, because if you do not understand fair value gaps at this point, you will not understand inverse fair value gaps. So if you do not have an understanding of fair value gaps yet, go back and watch the fair value gap again. If you don't get an understanding through my video, do some more research, do some studying on maybe other people's videos on YouTube on fair value gaps. You need to have an understanding on fair value gaps and also liquidity. So make sure that you understand liquidity, fair value gaps. Liquidity, fair value gaps, make sure you understand that shit to a T before you start this video. And if you can't understand it through my videos, then go through other videos on YouTube as well to understand it even more. Now let's go over inverse fair value gaps, yo. Okay. What an inverse fair value gap is the disrespect of a fair value gap. Remember when I said fair value gap should get respected in bearish or bullish price action? Bullish fair value gap should get respected in bullish price action, and bearish ones should get respected in bearish price action. I enter off of the disrespect of those fair value gaps. That makes sense. All right, let's say that's a fair value gap. That's a fair value gap. Let me do one more so you can see. So this is the fair value gap right here. We got a sweep of some sort of liquidity up here. Let's say the third candle right here swept liquidity. Inverse fair value gap. What do you think it would be? What do you think the next candle would be if the next candle were to be the inverse fair value gap? This nigga calling me and shit. Next candle would be a down candle disrespecting this fair value gap. Right? Well, why would that be a model? Why would that be a reasonable entry? Because I know if price is not respecting this fair value gap, remember, what are the points of liquidity? What are the points of liquidity? What is the market always targeting in the market? What is the market always targeting? Think about it, my nigga. You should know this by now. Highs and lows and fair value gaps. So let's say there's a bunch of candles down here, right? A bunch of candles down here. But there is no fair value gap. No fair value gap here. But there is a significant low down here. Significant low down here that I want to target. I just gave it away, but so if it disrespects this fair value gap, what would be the next area it should go to? It's a low, because there's no fair value gaps within this leg, right? There's no fair value gaps in this leg. That's why it's my entry model, because I know if we get a sweep of liquidity, like let's say we get a sweep of a significant high, that I see in the higher time frame that I could step back and see. Let's see, it sweeps at high, right? Sweeps at high, and then the inverse is this, the gap below it. That's just like my confirmation that price wants to reverse from that high. If that makes sense. Let's say this is a 1 hour high over here that it just swept at this point. And there's a fair value gap, a bullish fair value gap below it, and where we have bullish price action so far up until this high. Once we sweep this high and then we reverse and we don't respect this bullish fair value gap, what does that show me? That shows me that it is bearish price action. So it gives me a confirmation that I could hop in a trade to the downside. And if I hop in this trade, it doesn't respect this fair value gap, then what do I target? Either the next fair value gap within the leg or the next significant low that I want to see price hit. Right? Let's say this is the next significant low. We don't see any fair value gaps within this leg. So I'll be targeting this. And more than likely than not, since the fucking strategy is so fucking good, you'll see some shit like this, right? It's not always gonna look like this, but you'll see some shit like this, and then you set your sell limit or your buy limit to once it hits this low, you just made a bunch of money right here because you entered off the sweep liquidity and the inverse fair value gap. So now since you entered right here, you take your profits down here at this low because it's only ever targeting fair value gaps in highs and lows. And again, there's no fair value gaps in this example, in this leg. So I would target this low. Now, if let's say that there was a fair value gap here, right? Let's say there was a fair value gap here. Let's make this a little lower. Come on, bro. Let's say there was a little fair value gap right here. So now, instead of targeting this low, I would partially target this gap right here, because this could be a point of liquidity that it's targeting before it goes back up to the upside. So once I entered in my position, my target would be this fair value gap because there's a fair value gap in the leg before the low. Okay, that should make sense so far. And so let me give you guys an example. All right, let me also show you another part of my strategy. Okay, so when I'm entering, let's say I'm entering, I don't know why I just undid that. Okay, right? Okay. Oh, this is hard to explain a little bit. Okay. So I entered right here, right? On the disrespect of this fair value gap. Now, if you guys often see me when I enter trades, or if you guys are in the live, I often move my stop loss to break even. So my position would be set up like this, right? So I have my RR tool just so you guys could understand what I'm talking about. And someone had asked what this meant. This just means where my stop loss would be at the top of this red box. My entry point would be at the gray line where the green box meets the red box, and then the bottom of the green box would be my take profit. So I enter off the disrespect of a fair value gap, and then I target the next point of liquidity. But if there is internal liquidity within that leg, I move my stop loss to break even if I believe that price can go lower, but it already hit some form of liquidity before that. So let me explain this in this example. So let's say I had high conviction. Let's say I had high conviction that price was going to go to this low right here, right? Let's say I had high conviction that I think price, I see this low and I feel like that price will go to this low. And you'll understand more of how to have conviction as you go through and have time on the charts and have screen time. But let's say, okay, I know that price will go to this low, and I have strong feeling that it will. But I see there's a fair value gap within that leg before that low that I know that price could reverse from, because you know if price sometimes respects fair value gaps. So I see the disrespect of this fair value gap, I enter right here. So my entry would be at the close the entry would be at the close of the fair value of the disrespect of the fair value gap. So once we get a close below the fair value gap, if you could see it right here. So it would let you see it's like, let's say the candle's like this, like this, like this, but then it closes like this and it doesn't close below this fair value gap. I'm not entering yet. I'm entering once it closes below. So once we get a nice close with the body, not the wick, with the body of the candle, once the body closes below the fair value gap is my entry. So I see this closes below. Now I'm in the trade. So I enter here, and then my thought process would be, I have conviction that I think price will go down to this low without stopping me out in coming back up. So but I see there's a fair value gap within the leg. So I'm like, okay, my stop loss would be, let me go in the, actually no. My stop loss would be up here because I know if it doesn't respect this inverse and it comes all the way up here, I'm out of the trade. I'll explain that in a second. But let's say it comes down here. It taps in this fair value gap. I would move my stop loss. So in this scenario, this would be a sell market order. So it would be considered a buy stop that would get me out of the trade and take my loss. So my buy stop would be up here. My buy stop would be right here. I've explained this to you guys. Hopefully that makes sense. My buy stop's right here. This is my entry. And let's say I'm risking $200. So that means if I'm risking $200, that means once price comes up to this point, I would lose $200 if I'm wrong with my decision. So once I enter here, I'm in as many contracts as I would be risking $200. And for this example, this would be, how many points is this? If you guys remember how to understand points, this is about 13 points. So that's $2 per point. So 2 times 14, 28, and then I would be risking $200. So that would be about like 8 contracts. So I'd be in 8 contracts. I hope this makes sense so far. If not, keep rewatching the video. So once price comes down to this once price comes down to this fair value gap right here, I know that I have a feeling that price will keep going. So I don't want to take profits at this fair value gap in this example, because I have conviction that it'll go here. That's when you move your stop loss to break even. You move your stop loss to break even. So now you have $0 of risk on the table. So now it's a free trade. So once it disrespects this fair value gap and taps into the next point of liquidity, I move my stop loss to break even, because I believe that price will keep going down. And if price is truly bearish, like I said before, in bearish price action, bullish fair value gaps should not be respected. If bullish fair value gaps should not be respected, it should shoot down here, not respect this fair value gap, inverse this fair value gap as well, give me more conviction that it will keep going lower, and it should take out this low. That's and you're in a free trade at this point, because your stop loss is at break even, meaning if it comes back up, you lose $0, you make $0, so you're breaking even, and then you target your low. That should make sense. Let me give you guys an example. Let me give you a textbook example from what trade did I take home. Let me just see what trade I took this week. It's the best example. We just rest tonight. Oh yeah, right here. 10 o'clock on 2 days ago. I don't know what time frame. 3 minute, right? 2 minute. I thought I answered on 3 minute. All right, same last. Okay. Where was that shit at? That was yesterday. What's it? Wednesday? Yeah. It's Monday. Oh, it's right here. Okay, let me give you guys my thought process so you can understand. This is an A+ example. A plus example. Okay, so we have New York session. New York session, if you guys paid attention to Zay's video, if he explained it correctly, from 8:30 to 11. So New York session is from 8:30 to 11. New York morning session, if you trade morning session, 8:30 to 11. Right? This is New York session. This whole time frame right here is New York AM session, is what we trade. We deserve rest tonight. Right? So from here to here is when I would be trading. So within this area, let's say I came and I'm on the charts at this point. If you guys are truly understanding what I've been talking about so far, I hope you guys can understand this. What would I want to see, or what do you see here? What stands out to you here? You might not get it, but because it's kind of advanced so far, but what do you see here? Remember and think liquidity, and think what significant liquidity levels that I've mentioned in previous videos. Relative equal highs and equal highs. Relative equal highs. We have relative equal highs right here. These are all relatively equal. So you want these areas to get swept because you know what's going to be there. A lot of liquidity, a lot of circulating money within these areas. And so we could see that there's lows below, relative equal lows below. So what do we want to see first? We want to see a sweep of this liquidity up here and then a move back down. We see there's significant liquidity levels up here, and there's also a 15-minute fair value gap up here. So what do we want to see? We want to see a tap into this fair value gap and then a sweep of all this liquidity and a tap into this fair value gap. Let's see what we can get. Okay, so now we got our sweep, right? Now we got our sweep. Let me go back one. Now we got our sweep. This is my play from the other day. So we got our sweep. We swept all this liquidity. We swept here, 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 all these highs right here. So now what I want to look for? I want to look for my entry model back to the downside because we swept a bunch of buy side liquidity. And what is my entry model? An inverse fair value gap, a disrespect of a fair value gap. So I would look for a fair value gap on any time frame that I want to trade. So I see there's a fair value gap on the 2 minute. So there's nothing on the 1 minute. Look at the 2 minute, 3 minute. There's not there. The 3 minute candle hasn't closed yet on this example, but so I look at the 2 minute. I see this fair value gap. I'm like, okay, if it disrespects this fair value gap and doesn't respect it, I know that it wants to at least go to this low. This is considered a internal low, intermediate term low. So I know if it disrespects these highs, that it wants to. I mean, if it sweeps these highs and disrespects this fair value gap, I know it wants to go to the next form of liquidity if it disrespects this fair value gap, which is this low. But that's not my target because I know that there's relative equal lows down here with this one and this one. These are relatively equal lows. I have my target set for down here. So I'm like, okay, boom. Okay, it disrespected this fair value gap. Now I'm going to enter, right? Now I enter here with my stop loss. My stop loss, just imagine my stop loss is right here. My stop loss is right here. I'm like, okay, once it sweeps this low, because it's an intermediate term low, even though this is not my target, once it sweeps this low, if price action is truly bearish and wants to continue down, it should push through this low and break structure rather than sweep this low and come back up. So I know once it sweeps this low, I can move my stop loss to break even because it's an intermediate term low. So let's see what it does. Boom. Strong candle, sweeps it, right? Sweeps it. So now, say I'm up 700, I want to put my stop loss this is my stop loss in this situation. Since it's a sell scenario, this is going to be a buy stop. So now I move my buy stop to break even because we just swept this low. But I have a feeling that it will go to here and it will go to these lows. But as you can see, price action is a little choppy, so I'm going to be a little cautious. So I'll take some profits here, and the rest of my profits I'll leave down here. So I target this low and this low. I'm like, okay, let's see what it does. See, it comes back up here, and then it sweeps this low. So so what I did here was, so you see how it came back to my entry model? Let me show you guys what I did here. I mean, it came back to my entry point, right? So that would have stopped me out at break even. So I would have lost $0. But I see there's a lower time frame fair value gap. Hopefully this is not too confusing. There's a lower time frame fair value gap here. And I'm saying, okay, maybe you could respect it. So I go down to the 30-second. You guys don't have to go all the way down to this time frame. It's not really necessary yet. But I'm like, okay, it's at a 1 minute fair value gap. So let me see if it disrespects another fair value gap on a lower time frame. And then I saw that it disrespected this fair value gap. I'm like, okay, since it stopped me out at break even, I'm down $0, I'm up $0. So let me re-enter at this point right here, right? So now I'm in a new position. And now I'm risking less points so I can enter more contracts and I could target lower or easier lows. So I'm like, okay, I'm gonna get, since price action is being a little choppy, I'm gonna take 50% of my position down here, target another low here, target another low here. And so if you guys see this, right? Since it disrespected this fair value gap, what would be the next point? Where would I move my stop loss to break even? What point does it have to get to for me to move my stop loss to break even? If you guys are paying attention. Right here. This intermediate term low. So once it sweeps this low, I move my buy stop to break even. And I want to take my risk off the table. Right? So boom. Shoots down there off the bat. Right? I'm up 345. Now I'm risking $0. Up 345, now I'm risking $0. And now my target is here. So boom, 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 right? Just like that, right? And so then I buy. I probably took like 75% of my position here. So I just made $700 off that. And then my next target would be this low right here. Once it sweep, I don't think it swept that low. I think it was playing. Oh, it swept that low. I'm in 3 contracts. Take another contract off here. And then I'll leave the rest for runners to these lows. And then as you could see, price kind of respected this big fair value gap up here and came back up to my entry, but I still have $0 left on the table, so I'll be out the trade once it came back to my entry. But as you could see, the power of inverse fair value gaps is that it's a good confirmation model, and it shows you where price wants to go. Now let me show you guys a buy scenario. Let me see where else I bought at recently, brother. What time was this? What day was this? 5 days ago. This was Friday. What time? We deserve rounds tonight. Oh. Friday. What's the date? Oh, right here. Oh, right here. Okay. So if you guys paid attention to liquidity part 2 video, let's go back. This is prime example. So at this point right here, on the higher time frame, I see this significant low that had, let me go back one more. Let's say at this point, right? I see this low right here. I see this low. This New York kill zone is 1045. I see this low right here. I'm like, okay, let's see if we sweep this low if I get reaction back to the upside because all these stop losses get swept at this point. You guys know liquidity. You guys understand liquidity sweep. So let's see if we can get a liquidity sweep at this level at sell side liquidity, and then a reaction back to the upside. So now I'm like, okay, let's see some. I'm like, okay. And then sometime at this point, the S&P, because you guys should understand this now, swept this low, even though NASDAQ did not sweep this low. It swept it at, I think, like right. Was this the 1 minute? Yeah. So it swept it at this point right here. So as you could see, this was this formed the SMT right here. If you guys watch Liquidity Part 2, which you guys should have, you guys would understand what an SMT is. If you didn't, go back and watch it. So it's at the end of the video where I explain SMTs. This was an SMT because ES swept the liquidity, this point right here. Let me just pull that shit up. Can I go replay on here too? S&P, let's see where it went. Let's see. Okay, boom. So this is the same low. This is the same low right here. Come on, bruh. This is the same low as this low right here, but on the correlated asset, which is the S&P, which is the only other correlated asset you have to pay attention to. So this low right here is the same low. This low right here. These are the same low. As you can see, S&P swept this low, but NQ didn't. So in my head, I'm like, that's a SMT, so I could still count this as a liquidity sweep. So now I could start looking for my entry model because it's the SMT and it swept it on ES. So now I have enough confluences where I can see that this is a good entry model, right? And so what I did was, okay, now what if you guys understand my thought process so far, what do you think I started to look for? Think about it, bro. I'm gonna text my girl back because she calling me and shit. Think about that shit. Now I'm looking for an inverse fair value gap. And where would I be targeting? In this example, think, bro. Don't just say you don't know, my nigga. Think. I'm looking for an inverse fair value gap. So I'm looking for this fair value gap right here to get disrespected. And then what do I be targeting? What's the most significant liquidity you could see in this leg? And remember what I said the most high probability liquidity area would be. Equal highs, right? So we have equal highs right here. Equal highs right here. And so then I'm like, okay, if I see this get disrespected and we have equal highs above, that's an entry right there. So off rip, I see this get disrespected. So now I probably entered in around like one contract. Oh, this is no, I entered like more than that. This is M&Q. I entered like, how many points is this? Reaches around tonight. 40 times. 40 times. So I entered probably like five or six contracts. So I entered right here. I'm like, okay, this is a good model because it disrespects this fair value gap, SMT. So I now have my two confluences. So now I'm pretty confident. And so if you're being wary if you're being cautious. This is an intermediate term high that you can move your stop loss to break even at. But I was waiting until this high got swept to move my stop loss to break even. So I see that it sweeps this high. Now I'm like, okay, I wanna see this get swept. Swept this high. Okay, now my stop loss is at break even. I move my stop loss to break even. Oh shit, I can have my stop loss now. Move my stop loss right here. My stop loss is this yellow line. Let me make it at break even. So now you can see the 0, 0. I have $0 on the line. I have $0 at risk. So now, even though, so you guys can see the profit. So I'm up $381, but I want price to come to this level. So then I have my take profit right here to make $600. And I know since it's equal highs, these are high probability to hit. So I'm like, okay, boom, boom. Now I'm out the trade. Now I just made $600. As you can see, SMT, sweep on ES, which is the S&P, inverse fair value gap, disrespect to the fair value gap. So what do I target now? I target the next fair value gap or the next high, or whatever area of liquidity I want to target. Inverse this fair value gap, saw these equal highs, targeted these equal highs. As you can see, there was not even one black candle. As you see how precise this shit was, not a single ounce of drawdown. And then we got out there, and as you could see, my target was correct. Just fucking pinpoint accuracy, you bitch ass nigga. Fuck is you talking about? Niggas can't do shit, and I'm teaching this shit for free. Like, come on, bro. Niggas need to lock in. Shit crazy. Niggas not showing up to the live and shit. Doing this shit for the free ski. Anyways, that should make sense so far. Let me go over my stop loss. Hopefully this video is not too long, but this is sauce, so it could be as long as I fucking want. Yeah. Stop loss. Stop loss, stop loss, stop loss. Let me just go through this example instead of drawing it. Where would I put my stop loss at? So I'm in this position right here. My stop loss would be down here. I'm risking about $250, so around here. Why would my stop loss be right here? Because if this inverse is not respected, it invalidates my idea. So what do I mean by that? You could treat inverses just like fair value gaps. So if this inverse is true, we should not get a candle back down like this, basically violating the inverse fair value gap. The inverse fair value gap is just this close above this fair value gap. So if the next candle we get closes, it's considered, for me, it's a soft stop loss. So if this next candle, for example, closed below this fair value gap, this inverse fair value gap, and it came back down and it wasn't respecting this area, then I would get out of the trade and I would manually close the trade. But so I wouldn't have a hard stop loss. And when I say hard stop loss, like a set stop loss right here, right? Let's say I'm in the trade, I wouldn't have a set stop like this. I would just have, if it closed below this area, like you see this box right here, let's say the next candle closed below this area with the body, not wick below this area, but closed below. Let's say it closed below this area, not like this. So if it came down here, I still wouldn't have closed the trade yet, but my stop loss wouldn't be there. Let's say it was here and it was chopping around like this, but it didn't close below this area. It didn't close below my box that I drew out, the inverse fair value gap. I still would not close. I wouldn't close a position for a loss until it closed below this area. Right? Does that make sense? So once it closes below, then I go like this, press it, and I'm out of the trade, and I just took a loss, and I'm not going to overtrade or none of that shit. But I wait for a close below the inverse fair value gap. So once we get that, that's when I consider it wrong. Not if it's wicking in and out, not if it has to close below the inverse fair value gap. Let me give you guys another example of violation of fair value, inverse fair value gap. Okay. Oh, there's a failed one on Monday. Let me show you guys a loss that I took. A really good setup, but it doesn't always work. That's just trading for you, brother. What time was this? This was Tuesday. Tuesday at 9:28. Get out of replay mode. Tuesday at 9:28. Right here. Let me show you guys my thought process of this loss. Okay. So we have the range. Where would the range be? If you guys watch the premium discount equilibrium video, where would the range be in this price action you guys see right here? The range would be here. As you guys could see, where did we sweep liquidity at? We swept sell side liquidity. Where did we sweep liquidity at? Swept it here. We're in this huge fair value gap. We came down to a discount. So I'm like, okay, we swept this liquidity, came down to a discount. Now let me look for an inverse fair value gap. We have this fair value gap right here, and I simply wait for it to get violated to enter the trade. As you can see, good little trade. We close above this fair value gap, triggering my entry. So then, how many points is this? So I entered off of, it's 14 points, so same shit, like 5 contracts. So I enter off 5 contracts right here. And so where would my stop loss be? My stop loss would be if we close below the inverse fair value gap. If we get a candle close below this area. So I see these relative equal highs up here. My target was here. And this fair value gap. And then this high up here. This high right here. That was my targets. That was my 2 targets. So if we get a close below this box, I'm out of the trade. So I'm like, okay, we're up. We up. Damn, nigga. I'm sitting there, I'm like, damn, boy. So I'm like, okay, we still haven't closed. You see how it wicked below this area, but we still haven't closed below the inverse fair value gap, so I'm still in the trade. That's why you don't use hard stops. So my stop loss wouldn't have triggered because I only close if it closes below this area. I'm like, okay, damn. Still hasn't closed below this area, just wicking. Okay, now it looks like it's gonna close. Now it officially pretty much closed. You could give it one more because it kind of respected this area. And so now, damn. So now it officially closed below this area. As you can see, it disrespected this inverse fair value gap. Because if price truly wants to reverse, this should not happen. This should not get disrespected. So that's why the logic behind this is if price is truly bearish, an inverse fair value gap is one of the strongest indicators that the market is going to reverse. So that just means that this area should not get retraced to. It should not be disrespected. So at this point, once this candle closes right here, I'm out of the trade and I close my position for a $155 loss. And so I'm all out right there. So I take a loss. And so my thought process for this day is if I take 2 losses any day, and if I take 2 losses, I'm done for the day. So now I'm like, okay, let me chill. Let me chill, man. We have market open at 9:30. Let's see if we can get another entry. Okay, we just swept more liquidity, and we still have liquidity to the upside to target. Just swept more liquidity. Let's see what we can get. Okay, price is looking like it may reverse. Sub liquidity, what am I looking for? For an inverse fair value gap. So I see this fair value gap. See this fair value gap? We just swept this liquidity. Nice little V-shaped recovery. We inverse this fair value gap. Now I enter. This is about probably 14 points again. So I'm about 6 contracts. Enter here. Then I target this high. Or not, then I'm targeting this high right here. But where would I move my stop loss to break even? I move my stop loss to break even at this point. Break even stop loss goes right here. This is my break even stop loss. So once it takes out that high, which it should, I move my stop loss to break even. Now I have $0 of risk on the table, because if it's truly bullish, it should not reject off this level and come back to my entry point. It should shoot through these highs. So I take profit. I have half of my position. What the fuck? My take profit will be up here, and then I would target swept this high, so I would take like 60-75% off here, then they'll leave the rest of my position for this high up here. As you can see, reversed off that area. It's hitting my break-even point, so I made about 75% of whatever my TP was. And I did not get out of this position at this point. This was not a fail, because you could see price never closed below this inverse fair value gap. It respected it, hit the high, didn't come back to my entry point, almost came back to my entry point, but did not come back to my entry point. And then it hit my first TP. That should make sense. Now let me go over my time frames that I enter off of. This is very important for my strategy. This is not the same thing as what Zay does. This is Tradian. This is my strategy. What I do is I do not enter off the 15. I do not enter off the hour. I do not enter off the 4 hour. I do not enter off the daily. I do not enter off the weekly or the monthly, whatever you want to do it. Anything above, including the 15-minute, I do not enter off of, due to the fact that since I use soft stops, which is like what I just explained, I do not have a set stop loss. I only close once it disrespects that inverse fair value gap. I am limiting my risk by not trading on these higher time frame fair value gaps. Because let's say I enter on a 15-minute fair value gap, there's so much room. As you can see, look at these wicks. There's so much room that on a 15-minute chart, how much price can move. Because it's 15 minutes of price action. Price could dump 100 points in 15 minutes, 300 points. So I don't trade on the higher time frame. That's just simply where I get my bias. So I get my bias, which I'll do a daily bias video. I get my bias from the 15-minute, hourly, or the 4 hour. And then I take my trades based off the 5-minute, 3-minute, 2-minute, 1 minute. So I look for higher time frame confluences on the 15 hour, 4 hour, and then I enter off the 5-minute, 3-minute, 2-minute, 1 minute, or the seconds. You guys don't need the seconds yet. Just stick to the 1 minute, 2 minute, 3 minute, and 5. So I look for bias on the 15-minute, 1 hour, 4 hour, and daily. Entry is on 1 minute, 2 minute, 3 minute, 5 minute, and that is it. I only enter on low time frame entries. And also, I'm not trying to sit in a trade for fucking 30 minutes to an hour. That's just fucking stupid. Like, what is the point of day trading if you're gonna be sitting in a trade all day? It doesn't make sense. So I take these trades. As you can see, this trade, how many minutes? This is a minute chart. So this trade took me it swept us at this time. I entered right here. 1, 2, 3, 4. This trade took me 4 minutes, and I made $500 on this trade. Like, I'm not gonna enter off the 15-minute. Like, let's say this was a 15-minute chart. As you know, time is fractal, and it translates to all time frames. Let's say this is a 15-minute chart. I entered here. This trade would take me 15, 30, an hour 30, 2 hours. This would be, what am I talking about? 15, 30, 45 an hour. This would be, I would be sitting in this trade for an hour long waiting for my TP to get hit. I'm not doing that. That's why you want to enter off of the 1 minute. Me personally, I prefer it. You want to enter off the 1 minute so you could get in and out. What's the point of day trading if you're not going to be in and out of a trade? And you want to give yourself as much freedom for the rest of the day. So you're entering off the 1, 2, 3, or 5 because of stuff like this. This is 4 minute trade and I'm done for the day. I'm good. I'm off the charts. I'm done. All right. So yeah, that's all I'm gonna give you guys for my entry model video. Hopefully that wasn't too much. I'll go a little bit more into depth on daily bias and stuff in a couple videos. That should be good. I'm tired of shit now. I just came back from the gym. I'm gonna catch y'all niggas, man. Any questions? Discord, you guys could see I answer all questions. Discord, hit me on my gram. If you got my number, hit my number. I'm answering all questions. Just let me know. I know how it is, so don't be afraid to ask no questions, bro. I'm all answering all questions. Somebody asked me a question at 3 in the morning yesterday. I answered that shit ASAP. Just hit me, buddy.